war in the Middle East. I quantify crude oil futures in a couple gap scenarios. All that and more on today's REKTelligence report. As a friendly reminder, everything in today's show is for informational purposes only. There is no investment advice given. All right, let's get into the show. Hey everyone, welcome. I'm Dave Bush. This is the All Markets Report, where I quantify across asset classes with an eye to the week ahead. And of course, this weekend we've just seen the United States, along with Israel, attack the country of Iran. And this is certainly a major conflict. I'm going to look at energy futures. We'll look at crude in a couple gap scenarios. I'll also take a look at Bitcoin, which has done a fourth ever technical event. All of that ahead. Stay tuned. All right, let's jump right into crude futures. And what I've done here is taken a historical look at any time that crude, which is West Texas Intermediate, futures have gapped open by at least 5%. And then by the close of that day, I'll explain that in a minute, and then exit 5 days later. So let's look at a few instances, this being the first, and then I'll summarize. So this was a drone attack in 2019 in September on the Saudi Aramco facilities, and this at the time was the single largest sudden disruption to global oil supply in history. And this took out nearly 6 million barrels per day, which was roughly at the time 5% of world supply. Crude gapped open 15% on that day. And let's take a look at that. You can see it's right in the middle of the chart, huge gap open. 5 days later, and more than 5 days later, you see this just constant bleed out, this drift downwards. So obviously with a 5-day hold, you can just visually see this was a losing proposition. And this did not buy the open. I'll just say this once, didn't buy the opening gap here, this back test. This simply bought the close of the day in which it gapped. It's a little bit of a limitation of TradingView. I won't go into those details, otherwise an immensely powerful program. But nevertheless, it will give us a sense of how crude has performed over roughly a week, 5 days later. So certainly a negative instance here if one had bought the gap. Okay, let's move on to March of 2020. And we see crude was actually already in this COVID free fall. COVID demand had collapsed naturally, and the Saudi-Russia price war launched on March 8th. Also was another factor for this weakness just generally at the time. And we saw this gap open, which was obviously greater than or equal to 5%. And once again, even though this was in a downtrend, completely different context than we saw in the last example. Let's take a look at one more. We see a massive gap up. This is recent. This is just last year. In June, U.S. airstrikes on 3 Iranian nuclear facilities between June 21st and 22nd, following Israel's initial strikes on Iran. So kind of a deja vu now, although at a much greater scale naturally right now. So this was previously one of the most direct U.S. Israel-Iran military confrontations. That is now history, literally, because, of course, the current attacks are certainly a massive magnitude higher. Nevertheless, we see here June 23rd, 2025, this gap up here and an instant deflation. That gap was filled. It was a massive bearish engulfing candle, engulfed the prior several days of action, in fact, and then crude became much more stable. All right, let's look at all these instances together. And this is 1983, or at least March of 1983 to the present. Anytime the crude is gapped up 5% or more, exit 5 days later, and buying the close of the gap day, as I mentioned earlier. So you can see the tendency is negative here. There have been 13 historical instances of this. And by the way, these results exclude the COVID negative oil day where crude went negative. Those results are even worse, but they really throw off the general tendency, which is what I'm trying to get at here. So back to these results. Total P&L, negative 41 and change percent across these 13 instances. Profitability here is usually lower 5 days later. So 46.15% of the time. Crude has been higher 5 days later, but the majority of the time it's not. And profit factor is deeply towards zero. It's 0.319. I almost said deeply negative, but we don't get a negative profit factor. If it's below 1, it just means that sum of gross losses is greater than the sum of gross gains, and that is quite low, 0.31. Now, what if crude gaps now? Now, you are probably watching this after the crude market has reopened on Sunday night. I'm recording this just before, but I wanted to look at both scenarios. So is buying a down gap in crude futures when it reopens, is that the profitable move? And here we go. The answer is no. Very similar look to what we just saw. This scenario is if one historically had bought a 5% or more down gap in crude, bought the close of that gap day and held it for 5 days and exited. It looks almost the same. 14 instances in this scenario, total P&L, negative 40 and change percent. Profit factor 0.362. Profitability 42.86% of the time. It's been higher later, majority lower. And obviously just no profitability here. All right, let's move to crypto. And I've got a Bitcoin scenario, which I want to look at. Before I look at the current conditions, let's look at similar conditions in the past where Bitcoin has fallen for at least 5 straight weeks and in the process lost 25% or more in that time span. So we have to go back to April of 2014. You can see 5 straight lower weekly closes. And this very wonderfully would have bought the low, right? You see a hammer candle triggered at the end of that week. An exit 12 weeks later, that's what I use, 3 months roughly. You can see this would have been nicely higher, was nicely higher, it would have been a nice trade. Let's move on to some other instances. We go to later 2014. This is very late in the year, December and late December 2014. Again, 5 lower weekly closes consecutively, 25% or more lost in that time span with a 12-week hold. Quite a roller coaster ride here. Terrifying downslide, and we see a nice recovery and a little bleed out, and ultimately would have been slightly lower in this instance. Let's keep going. This brings us to May of 2022, 5 straight weeks lower, and this is fairly recently, at least in my mind, right? This is the last bear market. You can see 12 weeks later, there was a lot more downside to come in this particular scenario. So you see we had to really see all the deleveraging, FTX collapse, and all of that. 12 weeks later, there was a little bounce off the low, but it was much lower than that initial hypothetical entry. And that brings us to right now. Almost forgot to show you this summary. Again, only 3 historical instances where this has happened and then been closed. The 4th just occurred, obviously does not count in this total. So only 3 trades historically. And the total P&L is slightly negative, right, over all 3, despite all the ups and downs within those historical instances. So obviously we don't have anything statistically significant, no huge takeaways here, but it's a mixed bag is pretty much all you can say at this point. All right, folks, thanks for watching today's All Markets Report. Should be an interesting week for equities as well. I will be updating those in notes as well as on Thursday's Edge Report, where I quantify specific opportunities based on current market action. Until then, trade smart, live well, and cheers from the Caribbean.